This is Mark Sobel, U.S. Chair OMFIF. Today, I'm delighted to be joined by Stephen Cecchetti and Christopher Smart, two Bostonians, for a brief chat on yesterday's FOMC outcome. Steve is a professor of international finance at Brandeis, former head of the Economics and Monetary Department at the BIS, a former Fed staffer as well, and he has too many other accolades to recount. Christopher is chief global strategist and head of the Barings Investment Institute, and used to be a colleague of mine at the Treasury before abandoning our august institution to assume a senior NSC position. They have plenty of time today to discuss the FOMC with me because they're not watching the Boston Red Sox in the World Series. Welcome.
Thanks for having me, Mark.
Nice to be here.
Great. Well, I'll just ask a basic, simple question. What's your overall take on yesterday's FOMC meeting statement and press conference? Did anything surprise you? We'll start with Christopher.
I think the only thing that was surprising was how clear maybe the message, clear and unnuanced and unvarnished the message came through from Chair Powell. A lot of times I think he tries to say that the world is complicated and there are countervailing forces and we're really uncertain about what's going on, which tends to muddy the message, I think, in the ears of investors who, it seems are continuing to grasp at any hope of optimism or sign that the pace of tightening will start to slow. Yesterday, I think he was very clear that they are determined to keep raising rates and that they will continue to raise rates. And of course, they will think about whether it makes sense to change the pace at which they are raising rates. But they've been saying that for the last few months. And so you shouldn't read too much into that particular line in the Fed statement. I think partly is a reaction to the recent data, of course, that's been coming through on the hotter side, whether it's the jobs market data or the inflation data itself. So I think unlike a lot of other prior press conferences where there are folks debating, well, he meant this and no, he meant that, I think it was pretty clear what he said and pretty clear what he meant.
Steve.
Yeah, I mean, I think I agree completely with what Christopher said. I think that it was clear from everything that the chair said that they continue to understand the difficult road they're on, and they understand pretty much what they're going to have to do. He said a number of things that I'd point to that I think are all, for me at least, reassuring. He emphasized that price stability is essential for growth and prosperity. He said explicitly, and this isn't the first time he said this, but I think that it resonated, at least as I was listening to the press conference, it seemed much more forceful, where he said that it's going to take resolve and patience to ensure that we get to price stability. They've used that terminology now a couple of times, and I think that's very good. He also said, then I think that on the hawkish side, just to make sure that the message, as Christopher said, was coming through clearly, he said that it was premature to think about a pause. And he also said that they may have some way to go before policy is restrictive. And so I think that those things all combined, at least for me, are quite reassuring that they're committed to their price stability objective and that they know what it's going to take to get there.
Well, thank you for that. So let's flip the order this time and start with Steve. But there's a lot of talk about the future rate path. Will the Fed slow down, pivot, pause, stay higher for longer? What's the terminal Fed funds rate and the speed with which to get there? I presumably one's answer has a lot to do with one's assessment of the price and labor market outlook. So can you offer your thoughts on where the Fed's headed and talk about that in the context of your outlook for prices and employment? And if you can throw in a comment on whether you think the dot plot with respect to unemployment, I think it shows it going to 4.4. If that's just way too cheery, as many analysts have suggested. Steve.
Yeah, thanks. So that's a great set of questions, and let me try and make some headway. So first of all, on inflation, my sense from the measures that I think are good measures of trend inflation, by which I mean sort of medium term over the next couple of years, if you don't do anything, where's inflation, is in the range of about 5% right now on PCE, like personal consumption expenditure, like price indices. Those are the numbers that are consistent with the Dallas Fed's trimmed mean, and I think that they're also consistent with the fact that housing, shelter, as it's called in the CPI context, is such an important component of trend inflation, and is now running actually over 5%, for technical reasons I'd be happy to discuss, but I think they're a little bit too detailed for us this morning. So that's the baseline of where I started, sort of, 5%. You've got to get yourself down somehow from 5% to 2%. On unemployment, then the question there comes to this debate about vacancies versus unemployment. Governor Waller has spoken quite eloquently about this. Vacancies are very, very high. We're at the rate with this job openings data where there are about 1.8 vacancies per unemployed person. I don't want to take that too literally, but I think that what's more important to think about in the context of this thing that's known as the beverage curve, which is not a drink, by the way, but is regardless of what the closed captioning might have said when the chair mentioned the term. This is the relationship between unemployment and vacancies, and the thing is that this changes when there are when there's a lot of reallocation going on in the economy, which is happening post-pandemic, or still, at the tail end of the pandemic, as well as when there are problems with skill matching, which is both geographic and across sectors. So if you look at that, my sense is that you're probably looking at unemployment rates going somewhere between 5% and 6%. So I think those are pretty rosy. Now, in answer to your very first question, the chair was pretty clear. He said, we've got three parts: how fast, how high, and how long. He said that in the press conference. He didn't answer his question, but he did state the question. We have the luxury of trying to answer the question. I think that basically, we've gone up 200 basis points already in 8 months, more, and that's quite that's. But I'm sorry, we've got 100. Wait a minute, we've got 300 basis points. Sorry, in 8 months. My guess is that we have about another 200 basis points to go. As I said, inflation's about 5%, and so we've got to go to where there are significantly positive real rates. The chair was actually clear about that as well. And so I would say you've got to go there. And now then the question is, how fast can you go another 200 basis points, or at least 150, without creating too much volatility in markets, and without creating too much dislocation in the real economy? That's sort of something I'll leave for others to judge.
200 basis points. That's a lot higher than is common wisdom, I think. But Christopher, please.
No, I think that's where I think the risks lie, is that it's going to be more the term of the rates are going to top out higher than markets are currently predicting. Markets have clearly been grasping, as I said earlier, at any sign that relief is in sight. And anytime there was a day a few weeks ago where the Reserve Bank of Australia raised rates less than expectations, and markets around the world rallied because, my goodness, the end is in sight. And then we're once again sort of kicked in the head by inflation news, particularly in the US, that was running ahead of expectations. I think the labor market is key. I think wage growth is key. And I think my colleagues who focus on companies at a micro level will tell you, they're beginning to see some nervousness. Firms are sort of saying, well, maybe we're going to have to do some cost cutting next year, but it hasn't really happened yet. I think a lot of companies had such a hard time hiring back after the pandemic that they're reluctant to make big cuts now, given the uncertainties about next year. They've also been able to tap into markets pretty easily and pretty cheaply up until a few months ago. And so there's not a big liquidity or a balance sheet issue that they're facing, even if margins are starting to get squeezed. So that, I think, is part of the puzzle that we're trying to piece together here in terms of how much higher unemployment may need to go. I mean, I think we all, or at least I still fundamentally believe that Phillips curve works at some level, in some way, in some shape, and that unemployment does have to go higher from current levels. It's at a 50-year low, as the chairman said yesterday. But there is a lot of, there is pressure from job openings, which makes people feel like they can quit. That has to come down first. Once that comes down, the unemployment level has to start rising from 3.5 to 4.5. It is still, I think, a reasonable case that you could get away with unemployment that maybe tops out at 4.5 if some of these supply chain issues begin to come into place and the economy slows down or wage growth starts to level off. But again, as Steve suggests, I think the risks are to the upside, both in terms of unemployment having to go higher and the Fed funds rate having to top out higher.
Are you going to be as bold as Steve and say 200 basis points to go?
I don't think so. Our base case is that they stop out at 5 because that's what markets are pricing in right now. We had been, I think, ahead of markets in terms of thinking things would stay higher for longer. I'm a little more cautious at that, another 200 basis points, because we all know these things operate with a lag. The Fed knows it. Chair Powell said that himself yesterday. I think they will start to slow the pace of increases. And I think, barring some accident or disruption, they will, I would guess, top out in and around 5% in the first quarter of next year and then hold. And then see if that core PCE number that they're talking about starts to edge lower. Because of the uncertainty around this transition, it's not going to be 1 month or 2 months that will change their mind. They're going to need, I think, to see 3 out of 4 months heading in the right direction before they signal that they're ready to start easing. Again, that's all barring some kind of disruption on the lines that we've seen in the UK around their pension funds, where a sharp move in markets led to some real disruptions that the Bank of England had to intervene on behalf of. But if we don't see any of that, I would be betting that they would top out at 5 and hold it for much of next year before they start cutting.
Okay, we'll come back to.
Oh, can I just make? I'm sorry, I just get in one comment of it because I think it's something that's important, and that is Christopher mentioned financial conditions and lags, which this chair spoke about yesterday as well. I think it's important to keep in mind that financial conditions are moving before the funds rate moves, before the policy rate moves, but they're moving in anticipation that the policy rate will move. So that the idea that lags may have shortened as a consequence that is right, but it's also the case that it's important to follow through. That if policy rates then don't move or stop or slow down, as some people have suggested might be appropriate, because financial conditions have tightened in anticipation of of policy rates going up, then that would I think not work out for them. And for the rest of us. So they do need to, it's very good that this is being built into markets and therefore affecting the economy so quickly relative to what's happened in the past. I mean, certainly 30 years ago, this is not how it worked. But it does require, as the chair said yesterday, that they maintain their resolve.
And I'll just add, if I could just add in, there are some warning signs that are flashing yellow or red. The housing market is looking pretty ugly these days. Refinancings are looking kind of ugly. There's some pickup in, very small pickup in debt distress and debt default. So it's starting to work already. It's just that much of the rest of the economy continues strong.
All right, and we'll come back to some of those themes. And this point that Steve was making about lags is one I've heard Jason Furman make recently with us. So let me, sticking with Christopher and kind of amplifying on the prior question, do you expect a U.S. soft or hard landing? What's your expectation on the timing and depth of a recession, if you think that's what's going to happen? And what do you see as the upside and downside risks to your outlook?
Well, I think there are big upside and downside risks given the level of uncertainty that I think, the data is pretty confusing these days. I think I also, to quote our friend Jason Furman, I think, if you aren't confused by the data, you aren't paying attention. So I think the risks of the upside and downside are very high. Having said that, it doesn't feel like we're slipping into a sharp recession anytime soon, given the strength and the momentum in the economy, both in terms of households, in terms of corporates, and in terms of government spending, which is being cut, but not very quickly. And again, barring an unforeseen accident, we would see things slowing down, maybe a milder recession, but it doesn't necessarily have to be a recession that leads to, as I say, a very high unemployment rate, I don't think, as long as given the levels of savings and the strengths in balance sheets throughout the economy. The other thing that I think gives us some reason to think it might be softer is that our banking system is obviously in very good shape. Bank capital remains high. And so when the economy bottoms out and starts to grow again, there's a lot of firepower in the banking system to start lending again.
Steve, are you as optimistic?
I think that I try to be optimistic. And I'm usually pretty optimistic. As I always tell people, I would be a very bad risk manager. I'm not good at nightmares. So in this case, I don't think I have a nightmare. But as Chair Powell said also yesterday, he said the path is narrowed. One of the journalists tried to ask him how much or how, but I don't think he actually answered. Inflation, I think, is not coming down as quickly as anyone had hoped. Consumer demand continues to be strong and the labor market's still extremely tight. There's an interesting thing that's happened, though, that I think I haven't heard other people mention, and that is that there's been substantial fiscal drag this year. The Hutchins Center Fiscal Impact Tool suggests that the drag is on the order of 3.25 percentage points for this calendar year. That's because of the big stimulus last year, but that's still a pretty big number, and that it's going to continue to be 1.25 percentage points next year. Under those circumstances, I think it's pretty amazing that GDP has been flat over the last 9 months. That's an enormous amount of fiscal drag. So as the question then is, as the fiscal drag rolls off and the impact of monetary tightening, policy tightening kicks in, are we going to see even slower growth than we've been seeing this last 9 months, which, as I said, is flat? And I mean flat, the annualized rate is 0.1% for 3 quarters. And the answer, I guess, is I hope not. But as I suggested a few minutes ago, I think we are going to see higher unemployment, and there's considerable uncertainty over the current level of the natural rate of unemployment. My best guess is in fact that it's in the 5 to 6% range, rather than the 4 to 5% range. And given that we're at 3.5%, as Christopher said, a 50-year low, we have quite a ways to go. So while it's possible that growth is going to stagnate and the economy is not going to actually contract, labor market conditions are going to have to tighten considerably. And here I'll just simply note that we've never escaped a recession when there's been a sustained 1/2 percentage point increase in the unemployment rate. Even the September SEP has the unemployment rate going up by 0.9 percentage points. And so are we going to escape a recession? I think it's possible, but it doesn't seem likely.
And I would say that I think that sounds right to me. I didn't mean to sound overly sanguine about the future. I just think that there are reasons to believe that we will, if it comes, when it comes, it shouldn't be as deep as, we always compare things to 2008. There are lots of reasons to think we can bounce out of it more quickly.
Well, I also think that, again, that we're not going to see 1982 again. Right. I mean, that's my benchmark. 2008, I think, is sort of a
right.
Also, I should say I agree that I agree that financial stability risks are some people have mentioned those. They're not that serious. They're certainly not that serious in the regulated banking system. There may be some risks that are sort of submerged in the non-bank financial system. But I think that we're in far better shape than we were a dozen years ago.
Well, Steve is anticipating my next question, although I had an intervening short question for Christopher. So Steve said 200 basis points. Powell said the Fed has suggested that it would rather run the risk of having done too much than too little. How does that too much, too little worldview interact with your outlook?
I think it's what I've always sort of expected from the Fed. I mean, the second to last thing they want to do is to cause a serious recession, but the last thing they want to do is to lose control and have to take down all those pictures of Paul Volcker that everybody has up in their offices. I think out of embarrassment that they have shredded his legacy, and that's why they are so responsive. And a few weeks ago, when the inflation expectation surveys suggested this very tiny uptick in long-term inflation expectations, that's when they, I think, over the course of a weekend, changed the increment of rate tightening. That's what I think they're watching like a hawk, and that's why they would prefer to be too tight rather than too loose.
Okay, thank you. All right, let me throw a last question at you and then let you get off to your day jobs. So we did, as discussed earlier, we saw this liability-driven investment strategy hiccup or whatever in the UK. We've seen Archegos in the US, and there are other instances of such events. So how worried are you about a financial stability event in the US? And I take Steve's point that the banks are in much better shape, but there's this huge non-banking sector in the US, which, frankly, in my view, we haven't done anywhere near enough to address. And then looking more broadly, dollar's very strong, impacts around the world, emerging markets and the like. Any systemic worries out there? And since Maury Obstfeld wrote a piece that basically said that everybody's doing their own thing, but collectively they may overdo it, any thoughts on any of that? And I'll start with Steve.
So let me, at the risk of repeating and possibly distracting, you're asking a bunch of questions again. So let me start with the UK episode. I do think this was a real wake-up call because it casts serious doubt on the quality of regulation and supervision. As you may recall, there were in the Financial Policy Committee of the Bank of England's documents that were released several years ago mentions of this problem, and so it was known. Now, it's unfortunate that it occurred, but it is worrisome because I think of the UK as having a rather streamlined and flexible macroprudential policy framework, certainly relative to the US, where we have, I don't know, upwards of 150 separate regulators, depending on how you want to count them, and not a whole lot of coordination. I mean, it does raise the question of whether existing vulnerabilities are being overlooked, and whether we have the tools to address them once they surface. And I guess here I think there are concerns on both counts. There's the greater risk of overlooking vulnerabilities is, as you pointed out, Mark, in the non-bank sector, and having worked with you and others a decade ago on the financial regulatory reforms, I agree completely that we didn't do enough then, and our successors have not done enough since to ensure that there's sufficient resilience in the non-bank sector. And the question is whether we even have the tools available to us to do this. But since the official sector is in a perpetual arms race with the private sector, the private sector is always trying to hide risks away from regulators. I'm not sure that's anything new. On the monitoring front, so that's on the regulatory front, people always try to hide the leverage, and we need to know to be vigilant and where to go. Now, is it out there? I guess obviously I don't know, but I do think that the leveraged intermediaries, the highly leveraged intermediaries, are in far better shape. You also ask a question. You also ask a question then about the dollar. This is pretty far from what I really spend my time thinking about. It's what you always spent a lot of time thinking about, so you're in a better position to answer it than I am. I'll just mention the fact that there are I worry that there are a lot of emerging market economies out there with severe debt burdens, and that the high value of the dollar is going to make it much harder for them to meet those obligations, and that the risks are clearly greatest among the poorest countries. The IMF and the World Bank have been pretty clear about this. And I do think that there's a problem with the fact that China has decided not to participate in the Paris Club. So it's not exactly clear to me how, when those problems surface, we're going to actually be able to manage them, because it requires global cooperation to do it in a way that I think is the least cost to the world.
Absolutely agree with all of that. Of course, licks are not systemic for the global financial system in a way, but Christopher, please.
Well, I'll just say three things in an attempt to cover some of the same ground, or not cover the same ground, but try and answer your questions. The first one is, as somebody who probably is a representative of the shadow banking sector here, we have a number of clients. A lot of what we do is to take money from pension funds, endowments, and long-term investors and channel it into loans to mid-market companies that no longer have access to banks, because banks are pulling back from that book of business. And so when there is a disruption, when the market falls, we actually are much more counter-cyclical, in the sense that the vehicles, at least the ones that we manage, don't have leverage, don't pull back in a downturn, are restricted. The money is tied up for a period of time, so it doesn't cut and run when risk fears rise. And indeed, it starts coming in at lower valuations to help prop things up. Now, that's a personal, that's a plug on behalf of my employer and people like us, or other companies like us. That is not to say that there aren't a lot of other people out there doing a lot of different things that we don't understand, and that would make it would make us all more comfortable if regulators understood those things better. The second thing I'll say is you just never know, right? At every tightening cycle, something bad happens, and sometimes it's Mexico, and sometimes it's Orange County, and sometimes it's Lehman Brothers. Nobody's money, I don't think, was on the UK pension system, and it wasn't like there was great deal of mismanagement or malfeasance or abuse of the rules. It was just that nobody expected things to move so quickly in terms of the rates in the UK, or that there would be a chancellor of the exchequer that kind of threw caution to the wind and poured fuel on the flames as the market started melting down. But but clearly those are the unknown unknowns, and I don't think we'll ever know it until the headline hits. And I do worry about that. That is my biggest worry in terms of the next year for the base case that I've outlined for you, around with rates topping at 5% and a relatively mild recession towards the end of next year. The last thing I'll say is on the dollar. The dollar obviously benefits from two classes of investors. One is the bullish investors who look at the U.S. economy, think of it as the best story going these days, if you compare it certainly to Europe or China or Japan. And so money comes in because profits are good, because valuations are looking better. And so if you're bullish, that's a good place to be. The second group of investors for which it's attractive are those who are bearish. If you think the economy is going to come unraveled pretty quickly, you're looking for that safe haven. And so the dollar is benefiting from both of those flows. And to the extent that maybe Steve and I are right that rates are going to be a little bit higher for a little bit longer, or a lot higher for a lot longer, that's going to make this problem worse for other countries. But it will also help bring inflation down for the US, of course.
Great. So it's the old Warren Buffett saying, right, about you find out who's swimming naked when the tide goes out, and Christopher seems to expect a lot of nakedness, is what I'm hearing. Well, I promised only to keep you for a short time, and we've covered a lot of ground today. I'm sure we could go on and on, but this has been an excellent discussion. I've learned greatly from both of you. As always, I thank you for joining us today. You're welcome back anytime.
Great to be with you. Thanks,
Thanks
Mark.
very much, Mark. It's good to see you too, Christopher.